Hello and welcome to Integro Private Wealth Investment Market Update. My name's Tim Sullivan, Private Wealth Advisor and Director with Integro Private Wealth. And today it's great to have Phil Andronico, part of the team at InvestSense, join us here today. Phil's role and the role they play with our business is that they sit on our investment committee and they provide insights into our asset allocation decisions, our investment recommendations, and how we're sort of viewing markets. So it's great that Phil can join us today to provide us an update on what's sort of happening in markets. Phil, as we sort of know, global markets are facing pressure not seen in decades between trade wars, rising government debt, inflation risk, and financial system strains are creating unprecedented uncertainty, and consequences for investors could be significant. So today we wanted to start to just unpack that a little bit. So with that in mind, we've sort of seen since mid-February where there's been a pullback in markets sort of over the last month. How much of this is due to Trump's policy decisions versus other macro factors that are affecting the world economies at the present time?
It's a good way to frame it, Tim, because I think, it's always sort of funny when you sort of see the overnight news and the markets are down and they say, oh, it's due to Trump's policies of X or trade tariffs and things like that. And, you always wonder, it's like, do they go around and survey everyone in the market and say, was the market down yesterday because of this or for some other reason? So it's always hard to sort of completely pinpoint, the market outcomes, be it positively or negatively on sort of, one piece of news flow or outcomes. But there's no doubt that Trump's sort of narrative and policy decisions are sort of starting to feed through into markets and have an impact, no doubt. And I think, look, if you think about, Trump in his first time as president, the market was initially anticipating that it would be bad for markets, and then, the day he got elected, markets rallied quite strongly, and sort of so this time around, initially markets were sort of reasonably positive about the prospect of a Trump administration, but it's evident that this time he's come probably a little bit more prepared, and some of the rhetoric he had pre-election around tariffs and things like that, how much of it the market was questioning whether it was bluster or reality. And I think what's becoming apparent is that, some of these policies weren't just sort of bluster and, being positioned as a negotiation tactic. Maybe some of it is really going to be implemented. Obviously, it is changing by the day in some instances, and, things have been delayed. So there is still the possibility that these are purely negotiation tactics, and that at some point he may tone down the rhetoric. But you also have to be prepared for the possibility that this is just the way his second administration is going to try and implement economic policy. And so, we have to just take it into account in terms of scenarios. When you sort of look at the market, though, if you sort of look over, the last few years, and in particular 23 and 24, they were both very strong years by historical standards. And so, you think about the outcomes we're seeing year to date. The fact that the market, particularly the US market in Aussie dollar terms, was up 38, nearly 40% last year. And this year so far, we've had a pullback of around 6% in the US. In context, it isn't that significant a pullback. And if you sort of look at this chart here, this takes the US returns in US dollar terms, and it categorizes each calendar year into buckets of 0 to 10%, 10 to 20% returns, 20 to 30% returns, and also on the negative side. And you can sort of see there in this column here, there's 23, 24, and even 21 are all in the 20 to 30% bucket. Even 2020, which was the year of COVID, where we had a 30% drawdown, markets in the US was still up over that period of time. And it was only 2022 where we saw that sort of negative return period. So, the last 4 out of the last 5 years have been, by historical standards, very significant, better than average returns. And so it's not unusual, or should it be unexpected, to see a bit of a breather or pullback in markets from time to time. And, who knows where the end of 2025 ends up. But thus far, the recent pullback we're seeing isn't that significant by historical standards. And so, look, for the moment, it's evident we have to be a little bit cautious about what outcomes may come about. But, so far, we just think that, it shouldn't be unexpected to see this sort of behavior in markets from time to time, but particularly after a period of such strong returns.
So having said that, sort of that relative performance, US market versus sort of the rest of the world, we've been underweight the US, and up for a little while now. How are you sort of seeing the positioning of that sort of playing out within our portfolios, in the sort of the way forward from here?
Yeah, so I mean, interestingly, as you mentioned there, Tim, we have been underweight the US for a little bit, and a lot of that's driven by valuation views. And so, if you think back to 2024, in that period where at the start of the year, it wasn't just about the US and US tech in particular. It was actually, you had markets like Japan, Europe actually performing just as strongly as the others. And then it was really sort of the back half of the year where US and US tech in particular reasserted its dominance. So when you look at sort of, as an example, the Integro growth risk profile portfolios. In the first part of the year, they were sort of keeping pace with markets, even though we were underweight the US. And then, as you'd expect, in the second half of the year, as the US sort of started to perform a bit better, we lagged on the upside a bit. But when you sort of look at that relative positioning this year, you can see that the opposite happened. As the US has been the market that's sort of fallen by the most, the relative performance is slightly better when you compare it to what is a 70/30 index benchmark-like portfolio as a comparison. And so it's sort of comforting in some ways to know that the positioning we have taken for the risks that we foresee around valuations and earnings, is really just what we're trying to do there is just diversify the risk factors, right? We're not trying to swing for the fences and make these big hero calls, I suppose. All we're trying to say is saying, look, there's certain pockets of the market like the US where there is some potential risk around earnings or valuation, if you think of it that way. And there's other markets that look reasonable, and we just want to make sure we're diversified across all those markets. And whilst that means plenty of different scenarios could play out here, is obviously if the US reasserts itself and Trump's policies end up ultimately being more pro-US and affecting everywhere else more negatively, then we maybe return to 2024 where the US outperforms everyone else and we sort of lag a little bit. Conversely, if Trump's policies sort of end up sort of blowing up the US economy or even the global economy, typically what happens in those sort of pullbacks is the markets that are most expensive tend to fall by more, and the ones that tend to be a little bit more reasonably priced don't tend to fall by as much. So hopefully that sort of provides some sort of buffer. Ultimately, this portfolio, as an example, is a 70% growth portfolio, so it's still exposed to markets. And if markets pull back, the portfolios will have a pullback. But what we're trying to do is just dampen some of the volatility by thinking about that through diversification.
So given that volatility's increased, sort of we've seen it, particularly over the last few weeks, some clients that, many of the advisors here at Integro have been talking to, they're worried that it could go into free fall, where things are positioning. So should we be moving more aggressively to cash in this sort of period of time?
I mean, look, at an overall level, the portfolios, we've always had for the last couple of years, we've probably had a little bit of a neutral to slightly defensive stance anyway. So the way, obviously, as a business that Integro deals with this is to make sure that in the first instance, clients are in the appropriate risk profile, right? So that's one way to manage that sort of risk in terms of, what level of exposure should you have to markets versus more defensive assets such as cash and fixed interest. So the risk profile mechanism is one way in which to ensure that, clients are aligned to their sort of risk tolerance and ability to handle volatility. And then what we do around the sides of that is to sort of try and tilt the portfolios where we feel, okay, if markets are looking a bit expensive, we'll tilt a little bit more towards cash and fixed interest. And, if the opportunities arise, then we may take the opportunity to be much more aggressive than what the risk profile suggests, right? Now, over the last few years, it's been very difficult to justify being more aggressive, despite the fact that, as you can see in that first chart, markets performed very strongly over the last few years, right? So even in the face of rising markets, we've been looking at portfolio valuations across the market and saying, well, if we should be sort of trimming into that strength and also being a little bit more cautious about it. So we're already sort of neutral to sort of slightly defensive. Now, the question then about being much more aggressive and going really defensive is always a bit of a challenging one when you try to time markets. I mean, even Warren Buffett, one of the most successful investors in the world, who runs his company Berkshire Hathaway, What's quite topical in the news at times is the extent to which he's been increasing his cash positions, right? And so you can sort of see here that, it's not actually a new thing. He's just been a little bit more aggressive about it lately. And, at some level, he can afford to do this. He's a billionaire, so he can sort of afford to sort of wait. But you can see there, even in 21 before COVID and, since the bottom of COVID, he's been increasing his cash positions, yet the market's up 50% since that's occurred. So this just sort of shows you that even the best can't necessarily time markets. And the other thing I'd sort of point to is you can sort of see on this chart here, this is calendar year returns by asset classes. So it's a bit of a busy chart, but basically it just shows you the top performing asset class, be it international equities or Australian equities, etc., relative to the bottom performing one for each calendar year. And the thing you take away from this is a sort of got the last 15 years of market performance on here. And the grey bar is cash. And you can sort of see there that outside of 2022 and maybe 2018, where it was number 3, it tends to be in the bottom half of the table relative to the top half. And what this sort of shows you is that over the long run, markets do tend to outperform more defensive asset classes, notwithstanding the fact that every so often, probably once every, call it 7 to 12 years, you may go through a period of a pullback. But plenty of studies have shown, and we sort of put out a paper recently showing that, if you miss some of the best performing days, which tend to happen post a pullback, your relative returns had you stayed invested are much worse off. So it is very difficult to time markets. As I said, what we try to do is just sort of tilt the odds a little bit where we feel valuations are getting stretched, and we sort of average out a bit and put a bit aside. And then when markets do sort of have a bit of a pullback, that provides the opportunity to go back the other way. And as I said, the other way you then control that is by making sure your risk profile is appropriate for your circumstances and objectives. So, look, it's that said, I think, if you're a little bit concerned about markets, it doesn't hurt to be a little bit more cautious and maybe have a little bit of dry powder. And, we've certainly taken that approach somewhat in the portfolios themselves. Whether you potentially put a little bit more aside next to that is something you may want to discuss with your advisor at Integro. But just be conscious that, if markets turn around and rebound, you give up a little bit, and you just need to be comfortable with that as well. So it's a two-sided coin, I guess.
I think also the part that we often, in particular with clients in retirement or in drawdown phase, we do try to also sort of sequence, cash flow requirements, having them aligned to different buckets. So you might have a short, medium, and longer term bucket, so that we really are catering for when markets do, gyrate the way they have been as well, and sort of then aligning each one of those buckets to the particular risk profile from there. Mentioning Warren Buffett again, sort of just around, I sort of saw also over the last couple of days that he has started to enter back into the Japanese market or into some of the emerging markets. So as far as the investment philosophy and the way that we sort of look at where we're seeing value around the world, how do we sort of start to approach this probably opportunity as well as we're seeing in the markets at the present time?
Yeah, I mean, look, there is a bit of an interesting juxtaposition because, you can sort of see on this sort of chart, which we've called global tour of valuations. And, you can sort of see the US there had a 38% return last year, but trades on a forward price to earnings ratio of around 26 times. Whereas you look at places like Europe, they're trading on a price to earnings ratio of 15. Japan's on about 15.7. Europe, emerging markets around 14. Australia's a little bit elevated at just above 20 there. And so, you've got this relative valuation rubber band that's been stretched and been quite stretched for quite some time. Now, it's not to say just because the US is more expensive on that metric, therefore you should be out of that and you should be everywhere else. It's not as simple as that. You do need to really think about the earnings, and that is what we spend a lot of time thinking about. But what our valuation-driven process tries to do is understand that dynamic between what is driving those relative valuations. And so, Japan's an area we actually identified probably 2 or 3 years ago as somewhere to start being overweight, and that's how we've been positioned. And it's been a bit of a challenging market in some ways because there's easily recognizable value there. And even when we speak to active portfolio managers in the space, those who are exposed to Japan say, well, we're finding things that are trading on cheap valuations, growing earnings. 20% of their business is 20% of their valuations cash sitting on balance sheet. There's pretty good opportunities there. But I think it's just, in Japan is a bit of a funny economy because you've got a large component of it is global exporters. So that's how they drive. And then you've got a lot of more domestically focused businesses, which are actually quite good businesses. But most people just tend to focus on the big global dominant names, right? So there's actually a raft of opportunities there. And as you point out, it was actually Warren Buffett starting to invest there that started to shift the narrative a bit. And then in the last couple of years, that's been a pretty good market to be. And so I think that just shows you with a valuation-driven approach, you can sometimes identify the value, but it might take some time before the rest of the market decides, okay, that's true value. We want to be there, right? So you do have to have a little bit of patience when you adopt this sort of philosophy. And so when you look at the US, it's a sort of an interesting dynamic. And the way we try to think about it is this. Ultimately, the way we look at valuation isn't just about, a valuation metric, it's high valuation. We try to really understand what the driver of that is. And if you think about a company, right, if you own a business or, your own business and the earnings of that business are going up 10% every year, then theoretically the value of your business should be growing 10% every year, right? Because your, business should be worth more because the profit's bigger. And so we think about markets much the same way, right? Which is, okay, well, ultimately, if the earnings of the market are growing, within that economy, then the share price of what represents that market should go up. And you can see with the US here, the orange line represents earnings over the last decade, century and a bit. And you can see the blue line there represents the price of the market. And what you can see there is, generally speaking, they're fairly highly correlated, right? The earnings have grown and thus the share market has grown. Now, you do get periods of detachment where, you may hit a recession, earnings collapse, or prices get ahead of themselves or vice versa. And that creates the risk and opportunity in markets. Now, what you can see with the US at the moment is that earnings are sort of here, but the price has rallied much beyond where earnings were last year. And the reason for that is that the market believes that earnings are going to grow somewhere between 10 to 15% per annum over the next 3 years. And you can see here, this dotted arrow represents the consensus forecast. So these aren't our forecasts. This is just the forecast of analysts across the market around where they think earnings are going to grow to. And so you can sort of see that the market started to price in earnings probably for the next 12 to 18 months coming to fruition. Now, so from that perspective, if you believe the earnings come, the US market maybe doesn't look that expensive, right? But this is the problem you've got here, is that there's no margin for error in this. The earnings have to come, otherwise the market looks expensive. And so from our perspective, we wouldn't necessarily deem it as a valuation risk just yet. It's an earnings risk. The risk you're exposed to here is that earnings miss in the US corporates. And so from our perspective, we've still got exposure to the US, as you saw in those charts earlier. All we're trying to say is, look, we don't need to sort of put our eggs in this one basket. It's already a big part of the index. There is an earnings potential risk here, or a miss of earnings. And that can come out in many different ways. Maybe some of Trump's policies create a recession, therefore earnings collapse as a result of that. In some cases, it might just be, tariffs create distortion in markets, and some companies win, some companies lose. And, the US has got some pretty big companies that, are global dominant players, and, what effects may retaliatory tariffs have, etc. So you've just got a multitude of things that can impact these earnings. And all we're trying to be is a little bit cautious around that, saying, well, if on the other hand, prices were lower and the earnings expectations were sort of 10%, and the markets hadn't priced that in yet, you would be kind of looking at the US as saying, well, there's enough margin for error in that, you could invest in it, but there's just no margin for error in this. Whereas you can contrast that with Australia, we've got much more cyclical earnings. You can see there our earnings trajectory hasn't been as steep because we haven't got all those big US tech stocks. We're more commodity focused, so hence the cyclicality of it. And you can see there we've had a bit of a detachment also, where the earnings have actually come down, but the prices continue to rally on the sentiment, probably driven by global markets. So we've got a bit of disconnect in a different way. But that said, the earnings assumption that the market's got for the Australian market isn't that aggressive. It's sort of around 6 to 7% per annum for the next 3 years. So even if it's only 4, it's not that big a miss. But the US going from 15 to 7, which is still, a great earnings outcome of 7% earnings growth, is, it's a miss by half. So that's the sort of thing you just have to think about with the US is it's not wrong if you believe the earnings come, but all we're saying is let's just be a little bit mindful of the risk around that.
Phil, we've probably run out of time now, but look, appreciate you sharing your insights into what's taking place in the market at the moment. Look, just a general advice warning, just to sort of articulate that today is just a discussion around where we're seeing markets, some of the insights we're seeing. If there are specific questions that you do require, please talk to your advisor. No doubt there's other questions on your mind at the present time, but I would encourage you to reach out to your advisor and have a discussion. And we're more than happy to jump on another call and provide you with that insight as and when we get a chance to do so. So thanks for your time. Good to catch up, Phil, and we'll speak soon.
Thanks, Tim.